came out this morning cutting its full year production guidance 5% thanks to staff shortages due to COVID. Isn't every business going through that at the moment? And also weather-related uncertainties off the back of La Nina. Output in the second quarter took a hit, down 23%, though the outlook for metallurgical and thermal coal prices will be a tailwind and well supported over 2022. So what does the team think of this? Luke, you're close to the Hunter. This is your backyard. What do you think of Whitehaven's update today, and also the share market's been smashed today?
Yeah, well, Newcastle built on the back of coal. Whitehaven does a lot through the port here. It's a mixed bag of an update. Obviously, the production stuff is not great for Whitehaven, especially when you have elevated prices. It would be nice to maximise production and get the full, benefit of those higher prices. But look, it's not a surprise. We saw the headlines of those Gunnedah floods a few weeks back, so not a surprise that the Upper Hunter there were sort of some production issues. And I think as investors, you can probably look past that a little bit. The big question becomes over coal prices moving forward. The business is pretty bullish on that outlook, partly because of restrictions in Indonesia, restricting global supply. And look, this is a business I hadn't looked at it for a while, to be honest. And they mentioned in this update they expect to be net cash in this coming quarter, February, March. And I thought to myself, I was like, this is a business that had a lot of debt last time I looked. So I went back and had a look. And at the end of financial year 21, they had $800 million in net debt. So you're talking about wiping off nearly $1 billion in debt in a bit over sort of 8-9 months. You look at the market cap today, about $3 billion. Run those rough numbers. This is printing about 10% of its market cap every quarter at sort of the current coal prices and production levels. Now, wow. We know the space, and I think Claude will probably touch on it a bit more than I will around the ESG and the issues these guys face as maybe a terminal decline of some of their customers they're supplying to. But look, as value investors, if you're looking at a business like this, you're not talking about a long period of time where you could get a payback on your investment. Now, is management committed to returning that capital? I think so. Last time I checked, they've committed to dividends and stuff. Maybe not as much as you'd like to see, given the cash that's being printed, but it's good to see they're obviously paying down that debt. Look, it's not for me. I don't have a huge ESG overlay to my investing, but I must admit coal is one thing I've never really looked at, and mining in general, I suppose, but coal specifically. On those numbers, though, if you're the sort of investor that is willing to look past the ESG and can sort of have a bit of comfort around the coal price moving forward, I think you can step in and buy it today. But like I said, not for me, just for a certain type of investor that understands sort of what they're getting into. Okay.
Claude, you've got pretty strong ESG filters in your investment philosophy, don't you? So what do you think of Whitehaven Coal? And I understand, it's terminal, that energy sources are moving away from fossil fuels. That's going to take a long time, isn't it? And on the other side of it, there aren't going to be too many new coal mines built over the next 10 or 20 years. So dwindling supply, yes, it's on the way out, but gee, does it still have some value from an investment point of view now?
Yeah, so from an investment point of view, I think I probably agree with Luke. But it is still very important to think carefully about where the profits are going to come from if you do invest in Whitehaven Coal. Generally speaking, if we talk about buying a undervalued investment, the way we can make the money in two different ways. One is that the market realizes it's undervalued, says, oh, hey, let's not let this be undervalued anymore, bids it up, and then you can sell for a profit. And then the other way is that you just hold on to it super long term and get the dividends and the free cash flow coming back to you, or maybe the company itself buys back shares. That's sort of what we've seen with tobacco companies over the last decade or so. Essentially, the fact that they've had cheap shares because lots of people are avoiding them for ethical reasons has allowed investors to make good money off them. I think Whitehaven Coal is, as close as you get to sort of a tobacco style situation there, where it's clearly trading at a discount to where another industrial company with the same level of earnings would trade, because it is a coal company. But what you've also got to remember is that the chances of you getting a re-rate based on people deciding, hey, this is undervalued, we're going to bid it up, that is not particularly high. Like, that's possible, but over the long term, it's not super likely, because everybody knows it's undervalued. Everybody knows why it's undervalued. And this is when we have to start thinking about flows, right? Money is flowing away from this kind of activity because people around my age, around Luke's age, our generation have a drastically different approach to investing than past generations have. In the past, it's very socially acceptable to make money in coal mining. Now, you have a minority who sort of think it's very clever, and you have a majority of just the ordinary people who are like, no, I want to make money in a different way than that.
Yep.
And that is putting in place the settings for when millennials take political power to crush these kind of companies from a regulatory point of view. First, we get our money out of them, then we crush them. That is the plan. That is what millennials have to do, or our whole planet is going to burn. So step one is take your money out of these companies. Step two, once we get political power, we crush them with punitive taxes. We make them pay for the damage that they're doing that is currently a negative externality. The mine sites that are ruined, the farmers nearby that don't have access to water, and of course, the terrible emissions that are going to make the world unlivable for our children and grandchildren. So step one, take your money out. Step two, crush them. So I don't want to be holding it when the crush happens. So for that reason, I would avoid it.
Okay. Claude, can you be a bit more straightforward and not be so wishy-washy?
Well, I mean, I do agree. It's cheap on the numbers, right? So I think there's a possibility that you get paid by dividends. But what I would say is that the analysts have the earnings out at 30 cents per share, even in 2025, but the dividends only at 13 cents per share. So I would say this would be a real obvious buy if the company was committed to paying out all of their earnings, right? Because then they would pay you your money back really quickly. And I think maybe that's the end game for this kind of company, is actually do pay out all your earnings, but we're not there yet.